Hello and welcome to this episode of Mic'd Up. I'm Pete Seyler, a member of the business development team here at iCM, and today I'll be joined by iCM's Chief Investment Officer, Mike Paciotti. Mike, thanks for joining us.
Glad to be here, Pete.
All right, so to kick us off, in your soon-to-be-released market insights letter, Liar's Poker, you talk about markets always telling a story. Can you elaborate a little bit?
So, you know that you've been around a while when you get kind of all these catchy phrases, or so to speak, right? So this is kind of one of them, and it goes, markets are always telling us a story. Some choose not to listen. And what it really means or refers to is that often through its behavior, its price action, the market implies certain things about the future that are embedded in today's price, aka they're priced in. So the opportunity is understanding this story and why it ultimately might be wrong. So, like, in other words, pay attention to the story because eventually the market will find the truth. And then if you get there first, that's actually a pretty profitable strategy.
Yeah, I mean, we've long said that bubbles form one seemingly logical step at a time until you reach an unreasonable destination.
Yeah, ironically, that's another of our catchy phrases and closely related to stories that we're talking about today. So you might wonder how the market, which is the collective opinions of its participants, could get things so wrong. And it's not often by some gigantic single misstep.
Yeah, I mean, it'd be too easy to see it that way.
Yeah, so bubbles essentially form in a whisper it down the line sort of manner, right? What starts off as an aggressive assumption becomes stretched and morphed and extrapolated in a linear path until you get to a bubble, right? It's not one single thing that was really that unreasonable, but collectively they took you to an unreasonable place in small, unnoticeable increments.
Yeah, I mean, last year we saw strong returns from both stocks and bonds. The ags up over 5%, S&P up over 26%. And, you know, it's not that surprising that with inflation retreating from the highest of the highs that we saw in 22, but now we're near the halfway point of 2024, and markets they seem a bit disconnected, if I'm reading that right. You know, the S&P's up sharply, but bonds are slightly negative. What do you see as the story here?
So the story has several pieces, and it's really a disconnect between stocks and bonds in fundamentals, which is visible in the return disparity that you just mentioned, right? So when the Fed pivoted in December from the bias towards hiking to a cutting bias, fixed income markets reacted, pricing in a series of rate cuts, right? 7 to be precise, to the future path of interest rates. Equities simultaneously cheered that decision, rallying, 26%, as you stated, more from the December pivot, actually. So 7 rate cuts is a serious amount of policy easing, actually 175 basis points if it's done in 25 basis point increments. That was the story that was being told, right? A pretty ridiculous one in and of itself, that we would get all of that in 2024. So what happened was bonds recognized that over the next few months that it was pretty ridiculous, but equities really haven't. They're still pricing in aggressive cuts.
So as you just said, I mean, 7 rate cuts is a pretty strong move by the Fed by any measurement. What could prompt that?
A serious dose of economic weakness, right? So in the last 35 years, there have been 4 instances where the Fed has cut rates by at least 175 basis points. The early 1990s recession, the aftermath of the internet bubble, the great financial crisis, and COVID. Those were the events, right? So while the reduction in the discount rate would have been beneficial to long duration assets like stocks, that presumes that earnings are unaffected, which is unlikely in those environments, to say the least.
Okay, so what does this mean for stock valuations and bond yields? Where would we be if the world was normal?
So we can relate the valuation of the market to both the level of yields and the slope of the yield curve, right? As I mentioned, this impacts the discount rate for long duration assets like long-term bonds and stocks. So flat and low is really where you want to be. That's the perfect environment for stocks, right? Their long-term earnings are discounted by a really small number, resulting in a high present value and ultimately supporting that higher valuation for stocks. The opposite, high and steep, not so good, right? So we should see lower multiples in those environments. Today, we have kind of part of each, right? Higher but inverted. So based on this relationship, which is very predictive, the Shiller PE should be about 25 times earnings on the S&P based on yields today versus the 35 times earnings that we actually have. So stocks are a bit too rich based on what we see. But to illustrate the disconnect, we really need to ask what level of yields would support today's valuation. And ironically, the answer is approximately 7 rate cuts or 175 basis points lower than what we actually see.
So what you're saying is really stocks haven't gotten the memo and they're still pricing in these cuts.
Well, it doesn't appear so, right? And it actually goes a little farther. Not only are stocks pricing in aggressive cuts, which would require that meaningful economic weakness, it would also require no impact to earnings during the weakness, which is pretty unreasonable, right? So in each of those 4 environments that I mentioned, earnings took a pretty decent size hit, right? To make matters worse, the consensus expectation is for earnings to grow by 31% over the next 7 quarters, right? Which, by the way, may or may not be true. We actually think earnings might be pretty good this year. What is just a whopper of a story, though, is that you get all of these things happening simultaneously.
All right. So given all of this background, what do you feel is the best advice for investors with regards to kind of portfolio positioning?
Well, all of this is really unlikely to be true simultaneously, meaning that either stocks have it wrong or bonds have it wrong, right? So in bubbles, one of the final stages is what we call a blow off top, where you see all sorts of excessive risk taking and speculation, just kind of crazy stuff going on, right? So, what I would say is resist the urge to buy into this sort of temptation, right? Stick to your plan, rebalance, don't get lured in. You want to embrace bonds, right? While they haven't done particularly well in the last year or two, they really haven't been this attractive in 20 years, right? So for us, what this means is this left us generally underweight US equities in favor of more attractively valued opportunities from across the globe.
Mike, thanks for the insight. Thanks for joining us today.
Always glad to do it.
As always, if you have topic suggestions or additional questions, please don't hesitate to reach out to us via phone at 888-426-4689 or by email at info@icm-invest.com. That brings this episode of Mic'd Up to a close. Thanks for joining us.